What's up, Hot Take Nation? DRW, your host of the Hot Take of the Day podcast with the hot take over your commute, talking about the week of January 6th, coming off of a quiet week the week before with New Year's and coming back into work. And this week we had some excitement that we're going to get into. I was in New York just getting back and had a great trip. Got to spend some time with Alex Steele on Commodities Edge, talking about stocks, hedging, gas, natural gas, and expectations for Q4 earnings. So if you haven't seen that, check that out. It's on the website, and should be going back on in late February to talk real earnings. Harnessing the Mean Girls in me. I went to Mean Girls while I was in New York. Might seem a little strange for a solo dude in New York to choose to go to the Mean Girls musical, and I will say that the male to female ratio was about 9-1. But I was able to harness my inner Regina George, because I do get a little bit of shit sometimes that perhaps I'm not nice enough to management teams, and that's where we're going to start this week. Range Resources, I'm going to give them a shout out. They upped their game on the investor relations presentation side. In 2018, so I guess 2019 January, they were guiding capital for 2019. Their press release was maybe 4 lines, and it said, "We will spend $720 million this year." End of press release. So not a lot of information there when you're trying to tell your investors why you should be drilling gas when it's $2.15 an MCF. So we're going to start with my anti-mean girl call out of the week to Range Resources. Well done. Good improvement on your press release. You talked about your CapEx this year compared to last year. You talked about hedging. You talked about production expectations, and you went into your smog year-end valuation and number of PUDs. I mean, if I could come up with a template for all the other people out there, all the other companies that want to issue their Q4 and 2020 guidance, look to Range. I'll give you a shout out. Now, in fairness, Range is producing gas, and gas is $2.15, and it's very hard to be bullish on that. Next week, we're going to have Chris Calnan on the show to walk us through the Calnan Ventures acquisition of the Devon Barnett gas asset. So really excited about that. I think he can give some a different perspective on what natural gas is coming. So tune in for that. But Range also came out this week with a debt offering to refinance some old debt. And because of them being natural gas, but also a relatively high leverage player, their interest rate looks to be about 9.5% for the $500 million notes they've come out with. Now, compare that to another company that came out this week, WPX, who with the Felix transaction is paying $900 million in cash plus some stock to buy Felix. WPX was able to get their deal done, or at least guiding to 4.5%. And I think that that's a really key thing as we think about mergers and acquisitions in 2020. Range is trying to refinance debt with a bad balance sheet, and they're coming in at 9.5%. So while their press release was informative, and certainly their smog valuation looks attractive, to me, the leverage is a problem and the commodity is a problem. On the other hand, you have WPX, who, in Q3 guided that they had probably not enough inventory in the Bakken to keep them going. They came out, bought Felix, added a huge amount of inventory in the Delaware, cutting G&A. That looks really accretive, and then they were able to get a debt deal done. So I think that this is, again, like we talked about on the podcast last week with Cal and Carrizo, that's not an indication that it was that deals can't get done. That was a bad deal to do. On the other hand, PDC and SRC was a good deal to do because they overlapped entirely, consolidates G&A. So we're seeing these differences. And so while we're on the subject of M&A, G&A is also part of M&A, and we're going to talk about that with Apache and Oxy coming up a little bit later in the show. But I mentioned PDC and SRC. Their deal closes next week, January 14th. That company will go from 2 to 1. And like in all M&A, the best way to save money is to cut headcount. It's an unfortunate byproduct of the state of the industry right now. But in order to have cash flow, you're basically cutting heads to generate capital to drill wells and drill your returns. And that's the only way to go. Speaking of acquisitions closing, on Friday, January 10th, Jagged Peak was formerly acquired by Parsley Energy, and they will be transitioning some of their staff to Parsley in Austin, and obviously terminating some other positions. So for Denver itself, two, independent, medium, small size E&Ps gone. Consolidated one to Austin with Parsley and one to PDC, which is already in Denver. So look for debt and more M&A. I think we're going to see some M&A this week. I say that every week, but I do think we're going to have some fun on Merger Monday. Let's talk headcount reduction. So news this week, Oxy moved from a voluntary retirement program into an involuntary separation program, and Apache announced that they'll be closing their office in San Antonio on March 6th. So, again, a lot of jobs impacted in the Houston and San Antonio area. Sign of the times, we're able to do more with less in terms of the technology we have, the skills we have. Plus, we are not ramping up. The industry is 700 horizontal rigs right now. I think we're going to see 620 at some time in calendar 2020. The completion pace is down from where we were at the beginning of last year. And I would expect for the rest of the year, probably around 1,150 oily completions a month and about 100 to 150 gas completions. But the real driver on the rig count that I talked about dropping to 620 is if you look at the Haynesville and the Marcellus as two of the key drivers of natural gas, and you look at $2.15 in the dead of winter, what happens when we come into spring and shoulder season? I mean, you have to think at this point that gas is going to be trading from 1 to 150. And if you do an overlay, we're back to the same price environment that we were at in 2016. And in 2016, there were 11 Haynesville rigs running and 21 Marcellus rigs running, which would be about 50 below where we are today. Then take that plus consolidation. So we've seen Parsley take Jagged. We've seen SRC and PDC merge. We've seen Oxy take Anadarko. And in all those cases, that's resulted in consolidation of activity and a lowering of rig count. So if we see another 10 or 15 deals this year, which I expect that we will, I expect that the rest of the rig attrition will come from not drilling less core assets in the combined company. And we're going to see that ramp down, especially if we see some mergers coming out here in Q1. So that kind of catches us up on the big news of the week. Some debt, some M&A, some layoffs. Closing on the layoffs. It's always, I take zero joy in reporting that jobs are being lost. But as I said, that is the unfortunate side effect of the crisis of balance sheets and the inability to ramp up and the demand of investors for their cash back. And since we can't raise equity, if you can cut $50 million of G&A for a $10 million well, you get to drill 5 wells, which should have an ROI of 2. So you can turn 50 million into 100 million, which turns into a borrowing base, and you get a little bit more runway. So that's what companies are doing. In Oxy's case in particular, they didn't have enough voluntary retirements. And quite honestly, I'm happy that they're forcing retirements because, again, and to those who were caught up in this, perhaps you can send some comments and tell me I'm full of shit. But some people probably weren't the right cultural fit, and hopefully these layoffs are going to improve the remaining company. That's all we can hope for. And on the Apache side, it's always disappointing to see an entire office get closed. That's going to impact San Antonio a lot. But the reality is Apache surprised the market tremendously in the last week or two with both the JV that they did with Total and then the results they have on the Suriname well. That releases some capital that they can access for their U.S. onshore development or for Egyptian development. And to me, given their smog, and we talk about this a lot, their smog net of debt, net of 3 years of G&A and interest, to me, Apache's a $10 stock. They're trading at 32. If I'm sitting in BD at Apache, I have a strong relative value equity, and I am using that equity to buy someone in the Permian Basin to grow my inventory, move me away from the Alpine High until gas prices come back in the next 2 or 3 years, maybe, and give me some inventory that I can use my equity to really bolster the value of my company, to reduce my leverage, and get access to the capital markets. So I have Apache as one of the number one acquirers. I think they're going to be first So that's out there. That's my hot take for this week. Thank you for joining us on the Hot Take Over Your Commute podcast. I am David Ramsden Wood. Check us out on the web, www.hottakeoftheday.com, where you can find all our archived editions. And check me out with my book, What the F is Wrong with Everybody Else? What They Didn't Teach You in Business School, available now on Amazon. Thanks for joining. Be good, be safe, and have a great week.